In this week's video, we'll review the latest charts and studies to help us understand why stocks are vulnerable to much lower lows. We'll be moving quickly, so feel free to use the pause button on your video player. Just experienced the worst cross-asset sell-off in the markets since 1981. Bloomberg September 1st, global bonds tumble into their first bear market in a generation. We continue to have numerous moving parts relative to the Fed, economy, and inflation. And as we covered last week, typically the economic data tends to be weaker during recessionary periods relative to the data that we have in hand thus far in 2022. There were a few encouraging signs with Friday's NFP report, but nothing significant relative to this topic here. And despite Powell's somewhat perplexing neutral remarks in July, his Jackson Hole speech basically talked about what we talked about in these videos several weeks ago. Understanding that the Fed may have to raise rates and then keep them there based on the lessons from the 1970s, and respecting the significant challenges that are in place overseas and globally relative to the energy markets, it may be noteworthy that before the NFP report on Friday, the market had priced in approximately a 72% probability of a 75 basis point hike in September. That probability dropped during Friday's session, and you can make an argument that the markets are starting to get concerned about future economic data and earnings. NFP is behind us. We've got a big CPI report coming on September 13th, and then the Fed meeting on September 21st. And while this information on your screen may be good news, components here on the left side of the screen really only make up less than 20% of CPI, and thus it remains to be seen what type of improvement we see going forward. Now let's shift gears to the topic of competing themes and conflicting signals. Remember in last week's video we talked about reducing overall risk exposure, something that may have seemed odd in light of the recent breadth thrusts. From a common sense perspective, a month that's marked by numerous breadth thrusts, we wouldn't expect the S&P 500 to finish that month in the red, which is exactly what happened. That's a yellow flag. And that theme continued this week. The S&P 500 ended the week down 3.29%. There's a tweet up here from September 1st. If you're a client, I can assure you that we have an extremely detailed exit strategy and contingency plan in place. It was in place all week, and it will be in place when the markets open on Monday. So historically, the signals that we saw in the month of August had a very, very high correlation with major market lows, and after similar signals, the drawdowns tended to be relatively muted. And if you asked a logical question, why were we increasing risk exposure? Here's your answer. After similar signals to what we just saw in the month of August, 98% of the historical cases, the S&P 500 was not only higher a year later, but significantly higher. 2 years later, almost 40% higher, every single case green. That's an excellent historical risk-reward ratio relative to the historical drawdowns. But as we noted on August 19th via these bullet points, the term probability is significantly different from the term certainty. The signals shown on your screen here were generated after July 27th. Bloomberg article dated July 27th. Fed Chair Jerome Powell dangled the idea that the central bank has already done the bulk of what is needed to combat inflation. Now, given this topic that we had covered earlier this year, Powell's remarks were somewhat perplexing, but he made them. And as we always say, studies can help us better understand bullish probabilities as well as bearish probabilities. So as of the close on September 2nd, average and median drawdowns are shown based on those signals looking out 6 months via these horizontal lines. And you can see we've undercut both of those horizontal lines, and that tends to speak to decreasing bullish probabilities. We're also below the 50-day moving average and below this upward sloping trend line from the June low. Now, that would be the bad news from a probability perspective. The good news would be we're still not that far from these levels. These are average and median levels, so obviously historically some of the drawdowns were larger. We're still also in the time period window for a low, which based on these signals would be somewhere between August 12th and September 2nd. Here's where it gets a little more concerning. These are cases 1 through 20. We look quite a bit worse than those cases historically relative to the drawdowns. We've also undercut 21 through 40 relative to the historical drawdowns, leaving just a handful of the historical drawdowns that are below price in the present day. This would be the average and the median drawdown for the worst cases, cases 41 through 61. So we can make an argument that the breadth thrusts aren't necessarily dead, but it's probably fair to say they're on the probability ropes. Also received another very, very bullish signal that we covered the average gain a year out, roughly 25%. Historically, 100% of the cases were higher a year later. And every single one of the historical cases shown here occurred after the low was in. Drawdowns, extremely muted. This is an extremely favorable risk-reward ratio. But this is also a little bit concerning. From a historical perspective, here's the average and median drawdown. You can see we've already undercut most of those cases, which tells us we have decreasing probabilities relative to the potential validity of these signals in the present day. Not a zero probability, but decreasing probabilities. The further we get away from this cluster here, the more concerning it would become. So we're still within these bands here. And as of the close on Friday, September 2nd, we're holding some key levels. How about this signal? Again, signals came after major lows. Average gain looking out 1 year, 17.51% in the historical cases, with 100% of the cases higher. Again, an excellent risk-reward ratio historically, hence why we were increasing risk exposure. So where do we stand relative to these drawdowns? Better, worse, or about the same in the present day? Worse. And again, that speaks to increasing bearish probabilities. The further we get away from these lines here, the more concerning it becomes. Anyone that's using a data-based approach, so that would include Sentiment Trader, and that would include Dean, and that would include Shivako Capital, you have to be very, very flexible when the data changes. You can pause your video player here. This is what Dean's covering here. It's basically talking about the swift reversal that we just experienced in the S&P 500. Here are the signal dates here, and we looked at the maximum 1-year drawdowns relative to these dates and this signal here on the left side of your screen. And as you can see, they're very, very concerning. Something that just happened, something relatively rare. The average drawdown after the date of the signal and the date of the signal in the present day was August 26th. Average drawdown 21%, the median drawdown almost 13%. We're a handful of cases with relatively muted drawdowns. If we experience something similar in the present day, we hypothetically would come down into that 2020 cluster area that we've talked about in the past. Here's a look at the chart as of the close on September 2nd. This is September 1st. And if we were to say, how is it possible that we would come all the way down here? Well, the Nasdaq's already been down to that level. And thus, it's very, very possible that the S&P could do something very, very similar. And then logically, we could ask, well, if the Nasdaq's already been down here, is it possible for the Nasdaq to undercut that level? Here's that similar cluster, and you can see ARKK, or ARK, has undercut that level. ARKK has undercut the COVID peak, and ARKK is traded all the way down near the COVID low. So these would be similar reference points for the Nasdaq, similar reference points for the S&P 500. Simply telling us to keep an open mind about a wide range of outcomes, especially in the light of some signals that we've received after the breadth thrust. A more recent signal is more relevant. This is the message from the market more recently relative to the message that was given from the breath thrusts. It's also noteworthy. The breath thrust came after Powell talked about neutral. These signals came after Powell basically corrected that mistake at Jackson Hole. Again, you can pause your video player here. Here's the source A, source B, Twitter handle. Years when stocks were down 10% or more at the end of August, and that was true for us. Here are the dates identified here and here. We wanted to know, what did the maximum 1-year drawdown look like? Again, it's not pretty. The average drawdown, 20% plus. The median drawdown, if you round up, 20%. And again, common sense tells us if we can check this box in the same month that we received all of those historically bullish breath thrust signals, it's not particularly a good sign. How far would we potentially fall based on this signal date, the end of August, and these figures here related to the historical drawdowns? The average and median is pretty painful. It's down around 3,200 here and below the cluster that we've already talked about and below this COVID level here. All hypothetical. So how do we handle competing themes and conflicting signals? We have to look at the weight of the evidence that we currently have in hand, not the weight of the evidence that we had in hand 2 weeks ago, 1 week ago, 3 weeks ago, or on August 1st. How do our scores look? It's important to keep in mind here, regardless of what happens in the short run. We just experienced this signal down here at the end of Q2, 2 consecutive quarters where the S&P dropped more than 20% plus. And this table here is based on 2 separate signals, so the duplicate dates here are known and they're intentional. So even if things look dicey in the short run, remember, this table historically still applies. 1 year later, after something like this happened, which would be very similar to the end of the second quarter this year, stocks were higher 100% of the time, the average gain 28%. And typically, the drawdowns were relatively muted, but you can see 2008, which appears twice in this table, and it's done intentionally. Big drawdown, 2008 down here again because of this signal and this signal. They both apply to 2008. So if we look at the drawdowns just tied to the rare 2-quarter drop, if we were to fall further, that's not really anything out of the norm. This would be the average and the median here and here. If we followed a similar path in the present day, yes, more pain ahead. Could we undercut the lows? We could. But we have to keep in mind this would still be on the table historically. And it is still possible that we've made a low and we just need to retest that low. So how do our scores look? We know they improved from July 8th walking forward and hit a high of 51.51 on August 16th. August 26th, we were at roughly 45%. And at the end of this week, a more concerning, we really don't want to see these numbers dropping, 30%. And we'll learn something either way here. If they start to climb again, obviously that's good. If they continue to fall, that's concerning. So which way are the charts leaning relative to the conflicting signals? And really binary opposite signals. We have tables that are for the most part 100% green and tables that for the most part are extremely painful and red. And we could walk through a ton of charts. Before Powell, this looks like a bullish breakout and a successful retest. After Powell, it looks like a failed breakout. For the most part, you're going to have to pause your video player here. The present day, now that we're down here, is concerning. It looks like this, and it looks like this. You can make an argument that Powell's remarks were the primary reason the market rallied as it did, and we got a look like this. That was corrected at Jackson Hole, and now this on the right side of your screen looks different than the low in 2020. It looks worse. This is as of the close on September 2nd. NASDAQ new highs, new lows. What you want to see near a low, you want to see this in every single case. We don't have it in the present day. In fact, we're turning lower. Common theme here. This looks like a bullish breakout relative to this trend. Now it looks like a significant failure, and an undercut of this low and this line. August 11th, before Jackson Hole, this looks very, very constructive. Trends are what matter here. Now it looks like a concerning failed bullish breakout. There's information in failed breakouts typically, and it's possible we've got information relative to failed breadth thrusts. Pre-Jackson Hole looks really, really good. Post-Jackson Hole looks concerning. This indicator for the NASDAQ has already been down to this cluster area. If you're a stock market bull relative to risk on, you'd prefer to see Bitcoin retake 20,000. September 2nd, we're below it and below the trend line. This is your risk on look for the ratio. We've given up that trend line. We're still above this downward sloping trend line. It's possible we need to retest it. Concerning break, concerning, and on Friday we lost this RSI trend line. The good news would be on Friday we still closed above this area here. The concerning issue would be from a volume by price perspective, you have an air pocket here underneath. So if this low doesn't hold, very, very possible we could come down into these areas here. We're below the trend line. The longer we stay below it, the more relevant it becomes. We did not undercut Thursday's low on Friday. We're still in an area with some potential support. You can pause your video player here, but it's hard to make an argument that we look much different than this, and this. This is the DAX. This chart's dated September 1st. The DAX was up big on Friday, but that was before the pipeline news. So we'll have to see how Europe opens and what their futures look like on Sunday night, even though we're closed on Monday. This white space may need to be filled. Dow Jones Composite, broader than the industrials in terms of sector exposure. This weekly gap here has never been filled. Common theme would be when you use closing prices, a lot of these trend lines have been broken. When you use high-low close, many of them have not been broken, and they held on Thursday and Friday. This is Thursday's close, but we've covered this before. This is the credit markets. This is not really a good look here. Pause your video player here. This is 2008. This is the present day. This is rate of change in the present day. This is rate of change in the financial crisis, and this is rate of change during the dot-com bust bear market. This software index below the 200-week moving average. Similar concerning look here. Airlines have never filled this gap from the COVID push higher. It's not all bad news in the short run. We just talked about this. If you use high-low close bars, we've made a stand at this level twice. Doesn't mean it's going to hold. It just hasn't broken yet. Looks a lot worse if we use closing prices with this break here. The S&P's the same way. Dow Jones Industrials came back to the 38.2% retracement here. If you went to the 50% retracement, hypothetically, you would go into that cluster area. Somewhat of a mixed bag here. Broken this trend line on a closing basis, still hanging around this RSI line here, and still hanging around these levels here. If we look at the NASDAQ 100 in isolation, this looks worse and more concerning. Now, this is an overshoot and a reversal. This is an overshoot and a reversal. It's possible that this too is an overshoot and a reversal. That's why we always say the longer below, the more meaningful it becomes. NYSE Composite, this is a big gap here that hasn't been filled. This is the approximate drop from September 2nd, not a forecast. As of Friday's close, NYSE Composite has tested this line here really now twice, and thus far has held. And, like many charts, we have 50-day moving averages for the most part that have not rolled over yet. If really, really bad things are going to happen, we'll see something more like this. And that may happen in short order, but it really hasn't happened on many charts yet. You really don't want to have a look that looks like 2015 before the second leg down, looks like the financial crisis, or looks like this period in here during the dot-com bust. there are some similarities in the present day. This chart looks quite a bit different pre-Jackson Hole and post-Jackson Hole. Make an argument there's some similarities here to 2015, to 2008, and 2002. Like many charts, small caps below a downward sloping 200-day. 50-day is still up. We're below it. But in terms of volume by price, not a lot between where we are now and this cluster area down here. Remember we talked about ADX rolling over here, and typically that could be a good sign, but this is not what you want to see. You do not want to see ADX red now back above black. What do you want to see? 2009, black rolls over above green and red. See down here? Green is above black. That's what we want to see. It's not what we have so far. 23-week moving average, this is not an encouraging look. This allows you to compare RSI weekly to 2008 and 2000 to 2002. Notice here on COVID, you don't go back below the center line after the COVID low. We closed below it on Friday, September 2nd. It's also noteworthy for Morgan Stanley, if you use some fundamental factors, you can make an argument that the S&P 500 could potentially drop down to 3,000 or 3,400. This downward sloping trend line in interest rates goes back to the 1980s. Currently, we are above it. This is September 1st, but the trend, 2-year yield, remains up, and that typically speaks to expectations about Fed policy. Here's the VIX before Jackson Hole. Here's the VIX after Jackson Hole. Now, just like we held support on Friday, the VIX was relatively tame on Friday, September 2nd. 30, 40, 50-week moving averages, very, very difficult to say that the present-day look is not concerning. ARC versus defensive XLP has lost this upward sloping trend line. TSI, the True Strength Index, is back down below zero. September 2nd close, ARC has lost this important 41 level here. We closed at 40.59. All things being equal, if you're a stock market bull, you want to get back above this band. September 1st, leverage loans, credit, not an encouraging look. We lost this trend line on a closing basis. High yield before Powell, high yield after Powell. Still hanging around above these levels. Another look at software below the 200-week moving average. This chart goes all the way back to 2006. If you take a look at it, it's not particularly encouraging that corporate bonds are below the 200-week. Couple of concerning things here. Rejected here. That doesn't look particularly good. And number two, the longer we're below this upward sloping trend line, the more concerning it becomes. We had a bullish look here, and now we have a failed breakout look. Like every single chart we're talking about, comments are based on the chart in front of us. We'll see how it unfolds. This is the S&P 500 down here. If you pause your video player, you can see hard to call this encouraging. Tech XLK, the bad news would be high-low closed bars. We broke this trend line. The good news would be the closing price right here, September 2nd, is identical to the resistance levels here. Covered this many times. This still has an indecisive look here. Now, on Thursday and Friday, several support levels held on some major indices. And also on Friday, XLP underperformed XLK. Another chart that says we're trying to be patient in the very short term. XLY also outperformed XLP on Friday, September 2nd, and is really holding above these levels here. In fact, on Thursday and Friday, this ratio was up. Let's focus on some key takeaways. So again, these are signals. This is a 15% quarterly drop, which we did have in Q2, and this is 2 consecutive quarters. So as of June, the end of June this year, both of these signals applied. Again, hence the duplicate dates here. And we know we had a big drawdown in the 2008 case after December 31st. However, the market was still considerably higher a year later. So this green table here still applies to 2022 from two perspectives. We can check this box and this box, both of them at the end of June. Similar situation here. This signal, we've covered it in the past, is very, very similar to what's here on the left side of your screen. Yes, the drawdowns can be painful, but using this standard here, which again is very, very similar, even after the horrible drawdowns, 100% of the cases the market was higher a year later. The median gain was 23%. There's always another side. Always. How do we know that? Well, the market's recently made a new all-time high. And they eventually will make a new all-time high. The million-dollar question is, how long will that take? That's an unknown at this point. So this data set and this signal apply to the present day. It's still in play. So where do we stand relative to these drawdowns here? In our case, it was the first signal in the bear market, so that's what we're looking at here. If we followed a similar path, hypothetically, in the present day, we'd bottom somewhere between where we are now on September 2nd, and for the most part, somewhere near the cluster that we've been talking about. There's only one case where you significantly undercut that, and we have to respect that case in the present day. But after these drawdowns here, good things still happened. Higher in every case a year later. The first set of breath thrusts, we covered those on August 5th. The data wasn't as good as the following week, but still very, very good. Relatively muted drawdowns down here, and very, very good longer-term performance. It's interesting to note, relative to the historical drawdowns, so these would be the shallowish drawdowns, the average and median here. These are the cases in the middle, and that's right where we closed on September 2nd, and these are the worst cases here, telling us to keep an open mind about further downside, potentially to this cluster area here. Also noteworthy, this angle here, you can see price couldn't decide what to do here, closed basically right on it on September 2nd. We'll learn something either way here, not making any predictions about which way this is going to break, especially in the short run. And keep in mind, when we covered these signals, we also covered these bullet points here. It's a balanced approach. You can pause your video player here. These signals are based on this move here, the recent pullback. In these cases, the market held here. These levels, these are your drawdowns here, also near this upward sloping trend line. That would be the good news. The bad news would be we've undercut all of them, but we're still very, very close to them. And breath thrusts are widely used. That would apply here as well. Like us, Twitter handle here, concerned about the recent breath thrusts. That's also noteworthy. How is it possible that something like this could still happen? This would be an additional drawdown from the close on August 26th, hypothetically. Well, we've covered this in the past. When you experience a 20% bear market, which we checked that box back in June, the average and median drawdown here and here. And if you go back over the last century, the average recessionary bear market had additional losses, hypothetically, all the way down to this level here, telling us to keep an open mind about a wide range of outcomes. And notice this line here and this line here, near this cluster and near the COVID peak here. We already referenced these Morgan Stanley numbers earlier in the video. Here's the source. You may remember we covered this signal. Years when the S&P 500 was down 5% or more at the end of April. What was the average and median additional drawdown? Looking out a year, right here and right here. Where did we close on Friday? Right here. Where do these levels come in? Right near this W cluster that we've been talking about, and right near the COVID high. Covered this in detail in June, tells us to keep an open mind about further downside. Experience says this is a vulnerable look, and it was vulnerable here, but it was also vulnerable right here, and we had breath thrust and we plowed right through it. It's also vulnerable here. We had breath thrust, we plowed right through it. the market was making a very discernible long-term topping pattern here. The setups that we've had in 2022 look very, very similar here in 2016, and guess what? We plowed right through it. Breath thrusts in here as well. And when you have these bullish thrusts, in every single case near the major lows, you could have made the argument, how could you possibly buy with the fundamentals and the big picture so concerning? It's always concerning. It's very, very concerning in here, and the charts looked very, very toppy. We had thrusts and we pushed higher. Thus far, that doesn't seem to be working out. Another issue that we've got to deal with, thrusts are widely used by reputable firms, and the reputable firms also note that it doesn't always work. But this table here, average gain a year out, 20.3%. Concerning data point here from August 31st relative to central banks and interest rates. Sometimes it's good to look ahead and try to determine what you might be looking for. So when the market's falling, you can objectively assess. That's what we have here. The original tweet, August 31st, and then a follow-up on September 1st. Basically said there were certain things that we'd be looking for if the market came down here. Thus far, we have them. This is the look that we want. When we came down here on Friday, RSI stayed above 30. That would be the good news. The bad news would be you can make an argument we haven't even tested this trend line yet. So as of the close on Friday, the fact that we held 3,900, held some key levels, that RSI on this chart was at 38.6, that we have here price going lower here, momentum dissipating, price going lower, momentum dissipating. Doesn't tell us whether this is going to hold next week, but it was a reason to take a measured approach on Friday. We had our contingency plans in place all week. We only checked one set of boxes during the week. We came very, very close to checking some additional boxes at the end of the week, but we didn't check them. Another thing to consider on a daily chart, all things being equal after thrusts and during a rally attempt, we really prefer to see RSI hold above 36. We undercut it slightly on Friday. Mixed bag here. Roll over look, the 23-day moving average. We do have it. We don't have it on the 50 yet. That leans negative. We're still holding the upward sloping trend line. Some type of patience, and also on the S&P, the low on Friday was slightly above the low on Thursday. The bad news would be if we move in this direction, we've got another air pocket look here that could bring us down into that W cluster. All hypothetical. Market held here, and on Thursday and Friday, we've held there thus far. This area acted as resistance, support for one day on the way down, and support here. We're still in that general vicinity. We still have an upward sloping 50-day moving average. This is the 50-day moving average for the S&P 500 as of Friday's close. Good news, equal weight holding the upward sloping trend line even on a closing basis. The bad news would be this is a very, very concerning air pocket kind of look here that could take us all the way down to that W cluster. Again, all hypothetical. For clients, we're respecting risk here, and we have an extremely detailed approach. It's one that's flexible. If the data gets worse, we would reduce risk faster. If it improves, even if the market falls, we would reduce risk at a slower rate. We have failed breakouts. It's possible that we have failed breath thrust. Failed breakouts and failed breath thrust would be information, and it wouldn't be bullish. Not quite dead yet, but on the ropes. If we have failures right now, it's occurring within the context of longer-term downtrends. That is concerning. That's what this is right here. The breath thrust told you that we had a chance to get to the other side. We didn't make it to the other side. That's concerning. The margin of error for the bulls is getting very, very small. 3,900, still relevant. Remember, markets can overshoot. So if we undercut 3,900, the longer below, the more meaningful it becomes. If the bulls have a chance to have something good happen, it could come on September 13th. It's also possible that that could be good news for the bears. That's a big day. We talked about the strong economy last week. That means we may be able to avoid a recession. The problem is, that means the Fed may have to keep rates higher for longer. And the markets rallied on the near neutral comment from Powell. Well, that's been addressed. They addressed it at Jackson Hole. Heading into next week, we still have countless moving parts. This is one of the most complex markets we've ever been involved with. We have to respect that. Markets are forward-looking mechanisms. How could they possibly be bottoming? It's possible they're looking forward at improving inflation and a Fed that's going to back off a little bit. We still have to respect all scenarios, including an additional drawdown from current levels of 10 to 20%. Bottoming process is on the ropes, but not dead yet. Under our approach, contingency plans are prudent. We have them and we will keep them updated. And as always, we'll take it day by day. And the only way that any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.